Hello. Yesterday, I promised I would share one more problem with PE ratios. In addition to their unintuitive comparisons, there's a problem in terms of calculating the PE ratio of a portfolio. In all likelihood, you're doing it incorrectly. So let's look at the PE of a portfolio. Intuitively, we want to say that the P of a portfolio is just the weighted average of the P's of the individual assets. If we do that, here looking at a portfolio, we have again normalized the prices at 20 with some earnings there. We can see they're equally weighted at 25% each. Calculate the PE ratio. We take the weighted average. We get 67.5 as the PE ratio for the portfolio, which seems reasonable, right? We have P's ranging from 10 to 200. The weighted average seems reasonable at 67. Let's take another example, though. Let's consider that we want to sell that fourth asset that has the earnings of 0.1, and we want to instead buy an asset that has earnings of negative 0.1. In terms of their earnings, they're extremely similar, right? One is slightly above zero, one is slightly below zero. These should, intuitively speaking, have a minimal impact on the PE of the portfolio. If you think about, well, high PEs are expensive and low PEs are inexpensive. By dropping the earnings, we get more expensive. We would expect the PE ratio to increase slightly given this change in the portfolios. However, if we use our incorrect formula by just taking the simple weighted average of PEs, we see that the portfolio PE changes from 67.5, which seemed reasonable, to negative 32.5 with this small change in the portfolio with an asset that is extremely similar in terms of its PE ratio when you think about the change in the earnings. I can only conclude that this is not the correct way to calculate the PE of a portfolio, and I agree. So what it turns out, the correct way to calculate the PE of a portfolio is to take the weighted average of the earnings to price. Again, remember, when we use earnings to price, we don't have this weird distribution of ratios. They're consistently linear. If we take all of the EPs, take the weighted average of those, and then take the reciprocal of that, we get a portfolio PE of the original portfolio of 22.22. We could also take the weighted average of the prices and divide it by the weighted average of the earnings. We get the exact same number when we do it this way. And we can see that when we add this when we switch these assets to this one that is slightly less profitable, but otherwise very similar in terms of earnings, in fact, the PE ratio does increase slightly, as we would intuitively predict if we properly understand PE ratios, and our portfolio PE jumps up to 23.52, slightly up given the slight change in earnings. So all I can say is if you insist on using PE ratios, first remember that the distribution is very different, so it makes it very difficult to compare the PE of one stock to the PE of another. If you're going to do it and you're going to use it to calculate portfolio PEs, make sure you calculate the PE ratio of your portfolio correctly. Otherwise, what you're seeing is complete and utter nonsense. Thank you so much for listening.